Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Enbridge's stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 97 billion market cap. They're trading at $48 a share and they have 2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a ton. It went from 4.2 billion to 8.1 billion in the trailing 12 months. They just released their second quarter earnings the other day. We'll go through their financials in more detail. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaks in 2021 at 6.3 billion, down to 4.1 billion in the trailing 12 months. Midstream companies have lots of write-downs, lots of asset impairments. The more fixed assets a company has, the more likely it's going to have write-downs. Fixed assets are property, plant, and equipment. Companies like this have lots of pipeline infrastructure. They also have lots of expensive machinery and equipment. Revenue is a sales for the company, and that may move with the price of oil. It was really high in 2022 at 53 billion. Oil was much higher in 2022 compared to 2020. But it has come down to 47.5 billion in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 91 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $82 billion. We divide that by 2 billion shares. And we get a calculated stock price of $41. They're trading at $48, so they're trading at an 18% premium. It's a sell according to the model. But you do have to remember, you get a huge dividend when you buy a stock like this. Companies that pay big dividends are less likely to appreciate in stock price because the cash leaves the company and goes to the investor. Companies that do not pay a dividend are more likely to have stock price appreciation. There are 50 companies in the same industry as Enbridge, and if Enbridge has a number in red, they're worse than the median. If they have a number in blue, they're better. All these numbers are in US dollars, so they may differ from my model because I'm looking at the ticker that trades on the TSX. So all the numbers on my Excel file are Canadian dollars. Enbridge spends lots in CapEx, 3.7 billion. The only company that spends more is TC Energy. They spend almost 6 billion. All these companies are really leveraged because they pay high dividends and have to spend a lot in CapEx. So they need funds from somewhere. Enbridge's debt to equity ratio is 1.3. Every dollar of equity, they have $1.30 of debt. They pay a massive dividend, 7.4%, which is pretty close to the median, 7.1%, but higher than the average. Look at ET. I love ET. I own this stock, 8.7%. MPLX, 8.8%. Cheniere, 8.5%. Newstar, 9.2%. Companies that pay big dividends usually generate lots of consistent cash flow. As you can see, everybody generates a lot of cash flow except for TRP, TC Energy. Enbridge is the largest company in this space. They have a really good price to book, but their PE is worse than the median average. Their price to free cash flow is a little better than the average, worse than the median. And their price to sales is a little better than the median average. They generate lots of revenue. ET is the most by far at over 80 billion. Enterprise is second at 58 billion. Look at Plains, they're all the way down here, 10 billion market cap, and they generate 56 billion of revenue. That's why their price to sales is so good, 0.2. But the problem is Enbridge isn't really growing. Their 5-year annual revenue growth rate is only 1%. All these other companies are much stronger. Enbridge just released their second quarter financial results, and they missed on earnings and revenue. They just barely missed on earnings, but revenue they missed a lot. The expectation was 11.75 billion. They reported 10.43 billion, a miss of 11%. They missed on revenue now 4 quarters in a row. Let's go through their second quarter financials. We'll start with their income statement. And this column is the second quarter of 2023 compared to the second quarter of 2022. This column is the first half of 2023 compared to the first half of 2022. Revenue is down quite a bit from 13 billion to 10.4 billion. The main reason revenue is down is because commodity prices are down. You can see sales in commodities, 8.1 billion last quarter, now it's 4.7 billion. Gas distribution sales also down from 900 million to 800 million. Transportation and storage is what midstream companies do. That is up because that's not as reliant on commodity prices. That went from 4.2 billion to almost 5 billion. The main role of a midstream company is to store and transport oil from one point to another. Upstream companies actually pull the oil from the ground. That's the most risky part of the oil and production process. Downstream companies is the refining process. They refine the oil to turn into something useful, like jet fuel or gasoline or petroleum. Midstream is the middle part of the process, which is the least risky. Here's a further breakdown of the 10.4 billion of revenue. Pipeline transportation is 3.3 billion. Transporting gas is 1.4 billion. Storage is 1 billion. In addition to transporting and storing the products, they also sell it. That was 4.7 billion. The expenses that are linked to the 4.7 billion of commodity sales are 4.5 billion. So there's not much markup. They make most of their money on the storage and transportation of the products. They have 2 billion of operating and administrative costs. A lot of that is payroll, and 1.1 billion of depreciation and amortization. So total expenses 8 billion, operating income 2.4 billion. Up a lot from last year of 1.5 billion. With lower revenue, they have higher operating income. That's what you want to see. They invest in other companies. They earned about $500 million on that. Another 575 million in other income. They spent nearly 900 million of interest on their debt. Last year was 800 million. EBT, earnings before taxes, 2.5 billion. Earnings 2 billion. So their earnings are up more than 200% from last year. Earnings per share, 91 cents. Last year, 22 cents. For the first half of the year, EPS 177. Last year, 117. So they're really improving their margins. Let's look at their balance sheet. Their current assets, 9 billion. Current liabilities, 14 billion. So that's not good. Their current ratio is well below 1. They're going to need to take on more debt to get through the next 12 months. They have 1 billion of cash on their balance sheet, up from 860 million at the end of the year. They're owed 3.7 billion from their customers. Most of their assets are the pipelines and other infrastructure, 100 billion. Then they have long-term investments in other companies, 15 billion. 32 billion of goodwill. This is the premium you pay when you acquire another company. Total assets are down, 180 billion at the end of the year, 174 billion currently. Their accounts payable went down a lot. It was 6.2 billion, now it's 3.7 billion. This is what they owe other companies for buying on credit. They have 73 billion of long-term debt, similar to last year. Let's look at the equity. They raised 7 billion from selling preferred stock. They raised 65 billion from selling common stock. And they have a deficit of 14 billion. So if you sum up all their prior net incomes minus all the dividends they paid out, it's negative 14 billion. Let's look at their statement of cash flows. This is for the first half of 2023. Operating cash flow is 7.3 billion. And the way you calculate operating cash flow, you start with your net income, 3.9 billion. We add back 2.3 billion of depreciation and amortization. They pass through a gain of 995 million on their investments in other companies. That's a non-cash item, so we minus that out. But the companies they're invested in, they received 1.1 billion of dividend payments. That's a cash item, so we add that here. And then we adjust for changes in working capital. If they add accounts payable, that's a cash inflow. If they pay back accounts payable, it's a cash outflow. So they generated 7.3 billion of cash flow. Last year, they only generated 5.5 billion. They invested 2.1 billion in PP&E, property, plant, and equipment. They spent 487 million in acquisitions. They issued 5.6 billion of debentures. Debentures are unsecured debt that's backed by the full faith of this company. If you have a loan on your home, that's secured debt. Your home is backing the loan. Debenture is unsecured debt. Nothing is backing it. Just a promise that the company issuing the debt will pay it back. They paid 3.5 billion of dividends in the first half of the year, similar to last year. They've done 3 stock splits. In 1991, they did a 1.6 for 1 stock split. 2005, a 2 for 1. And 12 years ago in 2011, a 2 for 1. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $13,000 today. Not such a great return. A 3% annual return, a 33% total return. Let's look at the company on Simply Wall Street. We're looking at the Canadian stock. $48 a share, 97 billion market cap. Pretty much flat the past week, down 13% in the past year. Let's learn a little more about the company. They operate as an energy infrastructure company. They work in 5 segments. The liquids pipeline segment operates pipelines and related terminals to transport various grades of crude oil and other liquid hydrocarbons in Canada and the US. Their gas and midstream segment invests in natural gas pipelines and gathering and processing facilities in Canada and the US. The gas distribution and storage segment is involved in the natural gas utility operations, serving residential, commercial, and industrial customers in Ontario, as well as natural gas distribution activities in Quebec. The renewable power generation segment operates power generating assets such as wind, solar, geothermal, waste heat recovery, and transmission assets in North America. The energy services segment provides physical commodity marketing and logistical services to refiners, producers, and other customers in Canada and the US. They used to be known as IPL Energy Inc. and changed its name to Enbridge in '98. They were founded in 1949, 74 years ago, and headquartered in Calgary, Alberta, Canada. The risks they list are interest payments are not well covered by earnings, large one-off items impacting financials, and dividend of 7.4% not well covered. You can see from 1990 up through 2015, the stock pretty much only went up. That was its highest point ever in 2015, 65 Canadian dollars. Then it bottomed out in March 2020 at $35. It is up from the bottom, but trading about 20% below its all-time high. Simply Wall Street's valuation is 47. They say it's 3% overvalued. 19 analysts priced the stock at 58. They say it's 21% undervalued. Their trailing 12-month revenue in 2012 was 25 billion Canadian dollars. And then it had a fairly steady growth. It was down a little bit, but then it went right back up to 50 billion in 2019. It bottomed out in March 2021 as commodity prices came down a lot. It was 39 billion. It reached its highest point ever, 53 billion at the end of 2022. Now it's sitting at 48 billion. And the forecast is for the revenue to be 51 billion by 2025. You can see their debt has gone up a lot over the years. It was 22 billion in 2012. It jumped up to 68 billion in 2017. When you see a really big jump like that, it's probably due to an acquisition. Then it's been slowly increasing over the years, sitting around 79 billion currently, which is a little more than their equity, so their debt to equity ratio is 124%. The green line at the bottom is their cash balance, so they don't keep that much cash on their balance sheet relative to the debt and equity. They pay a really nice dividend of 7.4% compared to the industry average of 5.5%. Their payout ratio is 92%, so they pay out most of their earnings in dividends. If you want to receive the September 1st dividend, the next one, you have to own the stock on or before August 13th. If you buy the stock for the first time on August 14th, you won't get that dividend. You can see they raise their dividend every single year. It was $1.13 per share in 2012, and now it's up to about $3.55 a share. The forecast is for them to pay $3.76 per share by 2025. And the yield has also been increasing a lot over the years. In 2012, it was 2.9%. It peaked at over 8% in 2020. It's currently at 7%. In the past year, there's been only insider buying, no selling. 54% of the company is held by institutions and 46% by the general public. Vanguard is the biggest shareholder, 3.75%. BMO is Bank of Montreal. And then, of course, RBC is Royal Bank of Canada. You'll see a lot of Canadian companies on this list since they're one of the biggest Canadian companies that are trading. You see Bank of Nova Scotia, CIBC. Their employee count is up and down, 7,800 in 2012. It peaked at 13,000 in 2019. It's down to 11,100. Either they're laying off people or divesting parts of their businesses. The ticker trades on the TSX, New York Stock Exchange, Deutsche Börse, London Stock Exchange, and Bulgaria. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.